Everyone use that chat, okay? Appreciate it. All right, let's get started. Very good. So, welcome to Decoding the VIX. For purposes, make sure you check your emails and all this stuff because we plan to do a webinar per month, actually. And the topics obviously will be different every week. This one happens to be on the VIX. This is one that Brian came up with. It won't always be Brian, unfortunately, because he's a busy guy, and it's going to be, a variety of guest hosts, quite frankly. But this is a good one because this is a product, the VIX, that can be a little bit misunderstood, I think. So we're going to try to break this down a little bit. We're going to kind of, freewheel it here. We have a couple trades built into the system. We're going to share our screens. We're going to use whiteboards. We're going to talk about all kinds of things, and we'll hopefully get to a lot of your questions as well. First, let's introduce Brian Overby. He's the guy, right? The options guy. Brian, tell us a quick thing about yourself and we'll get going.
Well, inside the Tradier Hub, the name of my show is Options Guide TV, and I wrote a little book called the Options Playbook, and like to cover a lot of the VIX options. And I love the VIX mainly because it's a cash-settled index. I'd love to speculate. When I'm bored, I'd like to trade the VIX, but obviously you also like to trade it when you see it at extreme. So my background, I did work at the Chicago Board Option Exchange for a while, and I've done quite a few things, but ultimately, right now, I'm the founder of the company called Options Playbook Incorporated, and we're gonna, I guess, talk some VIX options today, Lex.
Yep, we are. Okay, good. So Brian's on our hub channel. He does a great show during the week. We'll talk about that a little later. Let's get going first of all on defining the VIX a little bit. Okay, so I know everyone um, the colloquial version is it's the fear gauge, the fear index, right? How do you take that? Do you consider it to be the fear index or what? What's your thoughts there? Or what is this product?
Well, you have to embrace that name because it gets mentioned all the time. But the concept that's behind the fear index is the fact that the VIX always is counter. It does exactly what the market does. So if the market's going down, the VIX has a tendency to go up, and that's because people are coming in and they are buying options in the S&P 500 index. If you ever look at the index, which I think a lot of people don't really know this, Lex, is if you look at the open interest in the S&P 500 index, you will almost always, 92% of the time, you will see more open interest on the out of the money put options in almost every expiration as opposed to the out of the money call options.
Hmm.
And that's not because everybody's bearish on the marketplace. It's because that is the index that they'd like to use as a portfolio manager to hedge portfolios. So when people are buying those option contracts, implied volatility has a tendency to increase. And that's why they call it the fear index, is because portfolio managers, individual investors are rushing to the market to buy some protection against their portfolio. And hence that has turned into, well, everybody's afraid of what's happening in the market. And hence the VIX is called the fear index.
Got it. Okay, so what the VIX measures too is it measures a variety of at-the-money options in the S&P 500, so the SPX part of it, right?
Mm-hmm.
So we're taking that implied volatility in SPX, calls and puts around at the money, slightly out on both sides. There's a fancy weighting number that they use to come up with this value, and then they take the square root of time of a 30-day rolling to come up with this VIX cash number, right?
Mm-hmm. That's
So
right. Mm-hmm.
the cash number is what everyone thinks the VIX is trading at, right?
Right.
And
And so we're gonna go
we
futures on we're gonna go futures on you out
we're
here,
going to go futures on you. That's not
right?
exactly how market makers price their Greeks and all their risk on the cash. They don't even use the cash, quite
Mm-hmm.
frankly. It's a number in their head, and that's about it. But where they price these things is where the true at the money lies in each of the months. So in VIX, which is very unusual, each serial month, meaning that third Friday, I think it's a Wednesday, the third Wednesday of the month has its own future attached to it. So what you cannot do at most brokerage firms is do a VIX calendar spread because they expire in two different futures. So
Right.
a lot of places don't let you do that. Isn't that correct?
That is correct. So the way that I look at it is VIX is a very interesting future in that if you have a future on corn, you can go and buy a bushel of corn and you can store it and you can have a concept of what that bushel of corn should be worth in the future. With the VIX, you don't have that. So I wrote a little article in my X.com profile called Decoding the VIX, and it compares trading VIX options to actually trading the weather forecast. In that, if you're trying to guess where the weather is going to be, the fact that I was once in Chicago on a Thanksgiving holiday and it was 80 degrees out doesn't mean that in January in Chicago that it's still going to be 80 degrees out, right? And that's kind of true about the VIX. You see the volatility spike this day because we have some news headlines, some new AI coming out, DeepSeek just hit, we're going to add some more tariffs. All of a sudden the volatility spikes, but that doesn't necessarily mean that in January that we're still going to have that high of volatility. So what that future tries to predict based off of what's going on in current trends is where volatility may be in the future. And that's really hard to do just because, like, what's the weather going to be in the future? You see trends that can help. The fact that that day in Chicago, where I know, is where both Lex and I have lived, and Lex is there now at this point in time. But that day on Thanksgiving does affect the trade or where vol might be in the future, but it's not taken as, oh, this is where that future is at. So when it comes down to it, and it's a little bit of a long walk here, but when it comes down to it, if you are trading that January future in November, you might be disappointed in the movement of the VIX on a spike up or on a spike down, because it's going to be much more muted because it's going to be based off of the future, not the cash, or another term that it gets referenced as a lot, Lex, is the spot index.
Right.
But now here's the thing. As expiration approaches, just like with any future, eventually it goes out at the spot, and that is the price. So as we get closer and closer to expiration, the VIX is going to merge into the futures contract's going to merge into the spot price, and eventually that will become the settlement on that third Friday of the month if we're just trading monthly VIX options.
Correct. Okay, good. So, how should the retail folks look at that cash or spot price? Is it relative really? I mean, how would you say that, do you think?
Well, it's more relative on shorter term options.
Okay,
Just
fair.
because
That's
of
fair.
what we said. So right now, we're going to go and we're going to do a couple of calculations. But if we're looking all the way out to January, the VIX closed today at 16 and a half, let's call it. And
Oh yeah, I see. Yeah, that's right. Yeah, okay, you got it.
around 16 and a half, derived value was 17 on
Yep.
the near term, but around 16 and a half. And, the January futures at 21, which that's fairly high volatility.
Yep.
But the marketplace is expecting more volatility as we go in towards the holidays and get into that month. So because of that, if you're trading the January expiration, realize that, okay, well, the spot is important, but right now that market is at 21. So like if you're buying a call option and you go out and you buy the 21 strike call, it's going to be a lot cheaper than you thought it should be, right?
Right.
Because the 21's at the money. It's not 5 points in the money.
Mm-hmm.
And just keep in mind that if you're quoting this and you're doing these trades, and we're going to give you a couple of tricks to calculating the VIX and in that expiration, and you're trading that VIX isn't really going to affect a January option contract. Now, December 17th, it's going to have a lot more effect because we got a few days away, and December 17th happens to be the normal monthly expiration.
Mm-hmm.
And, we're December 2nd, so we got 15 days away. So the actual volatility, the actual VIX index is going to have a lot more weight on the January or on the December option contract than on the January one.
Sure. Good. Well said. Okay. Should we have a look at the screen a little bit?
Yeah, so we gave a good little setup here. So how do we figure out that January option contract? And there's two ways that we can do it. So I'm going to start by showing everybody should be seeing Lex's screen right now. I'm seeing Tradier Pro though.
Yep. So if someone, anyone doesn't see it, just fire in the questions. No, otherwise, I hope you can see this. I'm assuming if I don't hear anything from folks that you can
I'm
see
seeing
this,
it.
which is
We're seeing it fine. But are we going to calculate? Are we going to look at the trade? Or you're going to calculate the combo?
let's do the combo first. Let's do a few of them. Okay, so here's what we're
Okay.
gonna do. We're gonna show you how the options produce and predict what the future price is out in time. Okay. And one simple formula. Okay. And I'm going to write on the screen. So bear with me. I write like a, you know what, a chimpanzee.
And
The
and
formula we typically use on the pro side is we take the strike price, which is always abbreviated K. Can you see that, Brian? Am I
yes,
drawing
I do.
well?
I see a
Okay.
K.
Plus, we're not going to get too mathy here. I'm going to try my best. Plus the quantity call minus put price, and we're going to use midpoints all the time here, guys. So just to get something in the middle
Especially
is,
because the market's closed, right? The
all right, and
market.
it's called is roughly equal to the future price. Okay, can you see that? Okay, makes
Yes.
sense.
Hmm.
So let's see how we're doing. Okay, now that's the formula that all market makers use. And again, in the old days, when I used to do this on the trading floor, we did this in our heads. In the new days, it's a computer that does it. So there's no computation anymore. The computers figure this out for you. All right, let's see what we got. Now, if you can see my screen, I'm going to clear the ticket out. And what I'm going to do is I'm going to choose an option that's roughly, around this spot price. And I'm just going to go up to the 17 and a half, okay, which is slightly above the what we consider to be at the money. So I'm going to click, I'm going to buy the call and sell the put so that it makes the difference between the two. If I buy them both, it's going to add them as a straddle. We don't want that. We want the combo, what we call the combo. Okay.
Can I say
If you
one
need to
thing?
enlarge your screen, make sure you enlarge it on your system. Hit the maximize button on that Zoom panel. You can do that in within Zoom.
So let me explain
Oh,
why the combo is important. Is that it's actually a synthetic version of the stock.
yep.
When you sell a put and the market goes down, you're going to get put that stock. Even though we're in an index. If you
Hmm.
buy a call and the market goes up and you exercise, you're going to buy that call. So
Right.
when you do the combo, you're going to either be buying stock because it went down, or you're going to be buying stock because it goes up. So that synthetically means that you're long stock, and that's where
Right.
the
And,
combo
and
comes from.
to your point, what I just did is I put this in the what if
There you
so
go.
that you can see that combo. I put
Yep.
that long call, short
Yep.
put, same strike, very important, same month. That's called a combo. It's synthetic long stock the way we delivered it. Being long the call, short the put is synthetic long stock. Look at this. This is the graph of a typical stock position. 45-degree angle, sloping upwards, right? You lose money when you're long stock to the downside. You make money when you're long stock to the upside. Very simple that way. Okay. You can always affect the price. Now, that combo needs to trade close to the underlying price or the future price. Otherwise, there's an arbitrage. Okay. And the market making community and all the geniuses and all the machines that exist in the world will not let that arbitrage happen. Maybe it happens for pennies that the machines can grab if you have $1 billion, but you aren't going to find that arb. It's going to be very close to what it is. So let's do this math, right? Now, bear with us. It's probably going to be pennies off because it closed. And when the markets close, they get a little weird and funky in wideness. But let's see how we do. So this combo in the ticket is, and I'm going to take the midpoint. Debit mid is 51 cents. We'll call it 50 just to make the math easy.
And this is the
So
December 17th expiration. Let's
that's right,
highlight that.
December 17th expiration. So if we had the strike price, which is 17.5 to our 50 cents, we'll just call it that, we get $18 on that one, right?
Hmm.
Sound right? Math good?
Yeah, looks
Let's
good.
have a look and see where our D's future is. 1795. Okay. So like I said, approximately 18. It's a nickel off. And that's okay because I can see the market's like this market is really wide, 61.88, and that tends to happen on the close. If we did this during normal trading hours, it'd be very much closer. But let's go out in time now. So keep that in your mind. We've got an $18 future in December. Let's have the next look, which is going to be Jan 21st is the next. I call them serial. Okay, let's go there to Jan, which I just clicked. And what I like to do to find the at the money without knowing off the top of my head is find two options that are kind of close together in price. So we're going to go, I'm going to do the 20 just because math's easier or without half strikes. All right, so let's do the 20 combo. Remember what that is. Buying the call, selling the put. Okay. And I did a negative, so I'm going to move this down one just to make it easier on us. Okay. So we get 14 cents on the 19 and a half line. So if I add 14 cents to 19 and a half, what do I get? 1964. Let's see how we did in January. Okay. Again, it's going to be pennies off, but the January futures 1960. That's considered the at the money out in January. Okay. That's right where we are on this. Right. We'll do one more and go farther out in time, see how we do. Okay. Um, pick one for us, Brian. How far out you want to go?
You
How
just
about
did
May?
May.
That's pretty far, right?
Yeah, I think it is. I mean, I
Uh,
can't use my toes and fingers to get there.
yeah, May is going to be, yeah, no
Yeah.
doubt. Okay, we're going to go to May 19th.
Uh-huh.
Same deal, right? Finding two options about the same. Let's go 21. Sounds about right. Right, they're right around in the threes. So buying the call, selling the put, we get 79 cents. I'll call it 80 for argument. If I add 80 to 21, I get 21.80 for that future price. Let's see how we do on May future, where it closed tonight. May future closed 21.72, about 8 cents different. Again, those markets are a little wide out there, and they were much tighter. If you look at this during the trading day, you will find these within a penny of being accurate. Okay. Any comments on all that, Brian? What do you think about all this?
Well, first of all, what is the site that you're looking at to get those futures numbers?
This site here
Yeah.
is the CBOE volatility index site. It's a CBOE.com, I believe. And they've got a bazillion places to look in there. And I think it's under market data. I don't remember exactly how I got there. I fidgeted
No
around a
problem.
little bit, but you
I'll
will
put
find
I'll
it.
put a link in. I'll put a link in. But yeah, if you type in VIX futures, they will give you. And I do think that they're delayed during the day. But you know, if the markets are closed, they're real time. That's a
That's right, which we figured out the hard way the other day, right?
So yeah, so if you do that, that will actually give you the futures. And it's really weird because I've always thought about this, and I had this back in the day when I was on the retail markets committee for the Chicago Board Option Exchange, which was quite a while ago. Um, you have a product that you are trading options on, and you're not giving the underlying value to them, right? You have to have a futures account to be able to get futures quotes. So for a while, and I don't know why it went away, but I did actually talk them into, if you typed in VIX May, it would give you the index that would track the VIX future.
Right.
And they went away. They no longer do that anymore. And I don't know if the futures people got mad at them. I tried to get an explanation, but for a while that was the case. So
Right.
now the alternative is you have to go to either that website or you have to do this quick calculation. And the one thing that I wanted to emphasize that Lex didn't highlight there, if it's a debit and you're looking on the call side of things, then you add it. If it's a
Right.
credit, you would subtract it. So if Lex used the 22 strike combo, he
Yep.
would have it would be done for a net credit and you would subtract it from the strike.
Yeah, so right, that's exactly right. Now remember this, remember the formula, folks. It's the strike plus the quantity, call minus put. Now, if the put's higher in this equation, it's going to be a negative number. Okay.
Yep.
And if a negative number is added to a positive one, you're going to subtract from that and take the sign of the larger, right? So it's not going to be larger than the strike price, but you're going to add a negative number to it. So it's going to reduce that price, as Brian just said, to get down to that future price. So remember the parentheses. It's important because you got to get that negative or positive number correct. Okay. Especially when you're
Right.
doing this in an Excel.
So if that didn't scare you, then we can go on out and we can come up with some conversations about the VIX. The VIX is one of the, I really like the VIX, and there are you get the VXX, you get other things that track the VIX index,
Mhm.
but I think the true number is the VIX, and that's my favorite underlying to trade. And then I also want to talk a little bit about the fact that we're focusing on the monthly expirations before we get out of the screen here. I don't know if we're going to get out of the screen,
We can get out of
but
the screen unless you want to do your butterfly.
nope,
You want to do that in a little
nope.
bit?
Go ahead and look at, just highlight the expirations and notice that the green VIX, see that?
Yep.
Where you got the green symbol?
Yep.
Those are monthly expirations.
Yeah. Let me circle them for everybody. So these are, when you see that, that is a monthly expiration. And I call them serial expirations. So that's the standard once a month expiration. And then everyone started adding weeklies. And what you'll see in nearer term options, is you'll see VIXW for weekly. Okay, when you see those are not the regular standard expirations. And I don't, Brian, I don't even know if they have futures on the weeklies, do they? I don't see a quote for those, so I don't
Well,
think
I
they
don't
do.
see
I
a
think
quote for them, but they have to have a future on them because they got to, they need to trade the underlying. But here's the bottom line is avoid them. I don't like to trade them. I don't like to trade the weeklies. The markets get really wide on it, and maybe they're wide because there's no future that trades
Yep.
on it, Lex. I honestly don't know that answer to it.
Okay.
But I'm assuming they have to have weeklies because I don't know why they wouldn't have a future that expires on that day. But
Right.
obviously, if you don't, then that could make it artificially wide. When you don't have an underlying that tracks the future perfectly or tracks the option contracts perfectly, it does make markets a little bit more illiquid. You got risks that are involved. I kind of think about it as stock ADRs that might trade on trade in Europe and trade in the U.S. Those
Hmm.
markets are wider sometimes because the
Yep.
underlying is in a different world.
Hmm.
Right? So that's kind
Yep.
of the way I look at it. So
Right.
so you want to avoid those. So that's one thing. So I always just kind of trade the monthlies, and the markets are usually really good. And another thing to go back, talking about the CBOE, I was wrong. I was on the retail markets committee, and I'm like, nobody's going to trade these VIX options like that.
Hmm.
That
How'd you
was
do?
my I didn't think anybody would trade them because I thought they were just too sophisticated. And it's been one of the Chicago Board Option Exchanges. Well, I should call it the CBOE now because it's
Yes.
no longer that name, the CBOE. It's been one of their big products that has paid the bills for years and years and years, and it still is very liquid and does really well.
Yeah. Now, how do you think most retail traders use this product? And if you don't know the answer to that, let's guess. And if you do know
Well,
the answer to
well,
it,
I think
what is a
Cliff
good
in, Cliff
suggestion to?
inside the Q&A actually answered it for us.
Okay.
So if I go to the Q&A, I see this, and we'll answer this live. But it says I've always heard to sell the VIX on high when the VIX is high and buy when it's low. What is the best instrument to use to make this play on in the VIX in the futures? Da 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 da. Da. So yeah, and that's where I see it all the time. Is our volume in the VIX when I was at a different brokerage firm back in the day always would skyrocket, especially when you would get the VIX to move to all-time highs. But now in the financial crisis, it was very weird, and I have to admit, I mean, I got burned on it on a couple of trades, and then I just kind of tapped out. But remember, the volatility just wouldn't come off. I mean, it
Hmm.
stayed high and it continued to stay high. But that was the one time in all my years of trading where it just would not come off. That volatility just would not go away. And you had a couple of WAMU, a couple of other those huge banks that actually just collapsed overall.
Hmm.
And so that was a big reason why. But that's how I see him trading it, Lex. And I
Okay.
guess we'll leave that as an answer.
Okay. Let me answer that. So I will say we answer that live. Okay.
Okay.
So another question here is, does the VIX trade with a margin account? You can't margin options. Okay, so that's a no. You got to pay for those. And then the second part is, do you need a futures account to actually trade this and hedge it? Technically, if you're going to hedge,
Mm-hmm.
you know, deltas in VIX, you would need to do that. Okay, technically.
You
But
would.
there's so many strategies that you don't even need to worry about that because you answered the second part of your question by saying that it is a cash settled index. So at expiration, you will get the cash value like SPX settles. You will not get delivered an underline or a barrel of oil or anything like that. It just settles in cash, right?
Mm-hmm.
So it is a good product in that respect. Now, if you're a hedger and you need to hedge deltas and you're like a true market making type person who needs to hedge those deltas, you're going to need a futures account to do something like that, right?
Right.
So hope that
Yes.
makes sense. Okay. Um, I'm just looking at these quickly. Okay, let's do this. Let's take a look at this, and I'd love for someone to answer this question for me. What do you know? Oh, I'm not sharing my screen, so you can't answer the question because you can't see my screen. So hang in there.
That is correct. I do not
All
see a
right.
screen.
coming back because you're so handsome. I want everyone to see you. That's
Oh,
all.
stop.
Oh, go on. Just go on. All right, here we go. So, what do you notice about this setup here, folks? And you can just type it into the chat if you want. Just what do you see with these numbers? Anything you notice about them? What are they doing as we go out in time? Kind of giving it away. Anything? Come on, someone answer. We'll give you a free Tradier cup or something. I'll figure something out to give you. I'm getting new hats too. Okay, they're getting larger, they're going up.
Yep.
Correct. They're getting greater. They're bigger numbers. There is a fancy term in VIX parlance that describes that, right? And you know what I'm going to try? I'm going to try the whiteboard because I've never used the whiteboard before and I'm dying to try it. So you got to tell me if we can see the whiteboard. And I am going to present. Can you see the whiteboard? Brian,
Yes.
you can see the
100%.
whiteboard. I
Yeah,
hope everyone can see the whiteboard.
I'm
All
looking
right.
at questions, but yeah.
Oh, sorry. All right. So what that larger number means, okay, what's going on there? I'm going to try to do my best drawing. I'm terrible with this mouse. Okay, I'm drawing a graph. We got an x-axis, which is time. And we got a y-axis, which is, I'll call it a future price. We call it, the vol, we'll call it future price, right? For now. And relative to what we just saw on that other screen, you notice that they started at a lower number and they kind of gradually arced up in time as we went out in time. So time's going out this way. This is expiration down here. That's 0. And we go to the cash price, whatever that is. This is called Contango, right? That means that the nearer term futures are lower than the farther term futures. This is a very typical setup in the VIX markets. This is predominantly how the term structure looks in VIX futures, right? So Brian, one of the reasons for this is, and you can add in whatever you want. One of the reasons for this is that people will spend their money and buy longer term, longer dated protection, okay, in terms of volatility. So what does Mr. Market Maker do to you? He says that you keep hitting me by buying, buying, buying. I'm going to sell and sell and sell. I'm going to raise prices. People
So I want you
tend
to
to move.
stop. I want you to stop buying. Right.
Yes. Well,
Right.
or pay exorbitant price that I'm willing to sell it at, right?
Mm-hmm.
So I'll sell hurricane insurance right on the beach, but you're going to pay for it. It's going to be expensive. That's what they typically do, and that's very common setup. Now, the other term that happens, okay? One of these is an eraser. I know that. I'm going to erase my chicken scratch here. Oh, I messed up. Look at. We'll get it. Don't worry. Okay. The other thing that happens is that this can happen too. This, can you see that?
Yes, I do.
That's
Right.
called backwardation. What's going on here? Well, all of a sudden, we have higher volatility in the near month than the farther month. Why would that happen? Does anyone know the answer to that? What's going on in that sort of scenario? So think about it this way. Remember when Trump threw the tariffs at us and we had up and down 2% markets every other day on a tweet? That all of a sudden brought tremendous fear day by day, night by night, based on what could go out on Twitter or X, okay, or what could happen with tariff policy. And it caused a ripple in the marketplace that caused fear to happen now. And whenever you get that massive movement in the near term, you'll tend to see this whole curve bend itself up here. Okay, when the back part of the curve still will go up, and I did this on purpose, but it's kind of like, think about a big metal sickle. You're just kind of winding it up, but it's still going up a little bit in the back, but it's really flexing in the front. Does that make sense, Brian?
Yeah, it does. And a lot of people got that right. A lot of people say people freaking out in the short term. Jim tossed that one out there. So Tony Gonzalez says, I still have nightmares of when that happened. So we got a couple of, obviously very astute attendants out there.
Yep, that's good. So keep in mind, you will see, and this goes back to the original question, I think. I can't remember who offered it. Do you sell this high VIX and buy this out here? You know what? probably not the worst strategy, but guess what's going to happen? You're gonna have a little pain for a little bit, right? And don't forget, you've got risk of having the time spread with your clearing firm or your brokerage because they're probably not going to let you do that, right?
Yeah, we never did as a brokerage firm. We never allowed anybody to do time spreads, otherwise known as horizontal spreads down on the floor, where you're buying something in the back month and you sell something in the front month. And we considered those two separate trades as far as margin is concerned. And
Mm-hmm.
so with the VIX, we never let you be naked VIX options because of the risk on it. That was another
Yep.
trade that we never allowed you to do. So basically, you couldn't do that trade. You had to be in the same expiration so that the same underlying, the same future is what was driving the prices of those option contracts.
Yep. Okay. Any more comments on contango versus backwardation for now? Are we good there? You think, Brian?
Yeah, well, I just would say that I want to trade contango, right? I want to trade. I want when the vol is high, this is when I'm more interested, and that's when we see more retail clients interested in it. And most of
Mhm.
the time it has paid out, but high implied volatility can go higher, just like anything else. And I mentioned the one time where I really got burned on it personally in my own trading. I
Mhm.
can talk all day long about my good trades, but the bad ones are more interesting, right? And
Yeah.
that was the financial crisis. I mean, we had the VIX hanging out around, gee, 40 was the new 20, if you
Mhm.
if you will, for months and months on end. And yeah, that was a scary time. That was a scary time.
Yeah. Yeah, I think there's I saw someone say something about mean reversion in VIX. I
Which is
think
in general the case, right?
it's generally the case, except the markets can be insane one way or the other longer than you can probably stomach. And the example that I have, I'm gonna stop the share of that. But the example
Okay.
I have of the downside is I remember a firm back when I was on the floor, they bought 11 VIX, they bought 10 VIX, they bought 9 VIX, and it settled at 7. And they had
Wow.
bazillions and they got killed. Now, oh, look at all things being equal, 10 VIX, really? That's
Right.
that you can see the floor from 10, right? So look,
Right.
you can get that way. When we had that financial crisis in '08, I seem to remember there's a 70 handle somewhere along the way, I think,
Oh yeah.
right? At
Hmm.
least. So it is nuts. Someone also said, and you guys in the audience, let me know how you feel about this, but especially if you own your own business, that relies on people coming to it. When COVID hit, restaurateurs virtually got hammered. Their cash flow dried up because no one could go to a restaurant. And someone said to me, knowing I'm in the market, say, "Hey, would it have been smart to buy out of the money calls in VIX as a protection on that?" I said, I think that's interesting. You are going to get paid once in a blue moon. And he's like, "Well, I pay for insurance anyhow now. I get burned every month on my insurance premiums. It's the same thing, and I could probably manage it a little better." I go, "It's a good point. Definitely a good point, but expect to lose every month probably. And one day you might hit a home run there to offset your loss of revenue on your regular business." I thought that was probably pretty clever thinking on the guy's part. He doesn't know anything about the markets. So,
Right. Now my issue with VIX's insurance is when do you get out? That's that, I'd rather, like, if I'm buying insurance, and this is part of the thing, you see the institutions come in and use the SPX more so than the VIX because you get the big spike up, and do I sell when the VIX hits 50 or is it going to 70? And if you don't and you blink an eye, before you know it, it's back down to 25.
yep.
And so that's my issue with the VIX is if I'm buying the SPX, the market goes down. I have more, I don't know, predictability about the market not coming back so fast. But with the VIX, you don't have that. So I don't like to use the VIX as a hedge in my own portfolio because I don't know when to get out of it.
Hmm.
Now, in general, if I do a VIX trade, I get out right away. Like if the VIX were to spike to 50, I don't wait for it to go to 55, right? I mean, you get that initial move. I sooner is better in my mind with the VIX because, like I said, the VIX can just come down because the market's not going anywhere, because the market's staying low, right? Not necessarily going lower, but the fact that it just calms down and you get a little bit less uncertainty. Maybe you get a little bit like tariffs are a great example. Maybe you just realize that, oh, by the way, we're not going to have a 200% tariff in China. And that news comes out. And because of that, the VIX comes in. The market doesn't go up, but the VIX comes in, right?
Yep.
So that was that's actually a good example. I'm going to have to use that one going forward.
Yeah. Okay, let's look at a trade that you like to do. I'm gonna share the screen again. You tell me what it is and I'll set it up for us. If that's okay.
So when Lex and I first were talking about this little event that we're having right now, the VIX was actually at around 22 or 23, and I kind of said, well, the actual VIX, the spot, was around 22 or 23, and I'm like, this is a time when I wouldn't mind doing a trade and fading it and thinking that it's going to come back to the mean. It's too bad we're not doing the show today, right? And that was back, I don't know, a month ago when we first started this conversation. So right now, I'm not that excited because we're kind of we're a little bit elevated considering that the market's still setting new highs. I guess we're at, well, the derived value is at 17. The spot is at 1650. So it's not ridiculously low, but it's, fairly low. The 200-day moving average is always a guesstimate to mean where the VIX should be. That's the reversion to the mean, wherever that 200-day moving average is at. And so with this instance, if I were to do a trade, I came up with one, and I don't mind this trade. I really don't. So
okay, is this the butterfly? Yep. Let me put it in here. I saved it. See, knowing
I do want to say that this is not meant to be a recommendation. We always got to throw that little disclaimer out there. We don't know, your financial situation. So throw it out, especially when you're trading VIX options, because they're obviously speculative. But here's I like to call it an open wing butterfly. Lex calls it a broken wing, which it gets, there's many different versions of broken wings.
Yep.
I'm going to call it an open wing because we're going to open up a wing. So in this instance, we're on the put side of the Tradier Pro platform, and we know that the future, because we just calculated, is fairly close to the 18. So when I'm doing these butterflies, I want to sell at the money vol, and that's the reason why. Now, you could say I just want to do a long put spread, and that's okay because you're going to be buying one and you're going to be selling an at the money vol. So if we did the long put spread here, Lex, we would just be buying the 21 and we'd sell one of the 18s.
Right.
Right?
Yep.
Okay. So that would be the long put spread. But why sell one when you can sell two?
100%.
And that's the difference here. We're going to still be directional because we're going to open up a wing on this, but we're going to get double the at the money vol premium on that 18 strike. So we're going to buy one, sell two, but now we're naked one. So let's go down a little bit and buy another one. And that means that if the market does go down below 17 and it starts creeping lower by that expiration date, that we stop short here and we can still be profitable. We open the wing. The long spread is 3 points wide. The short spread is 2 points wide. And if we go to the P&L calculator.
Yep. Let me show this real quick. Let me send it. I'll send it to both.
Vernacular.
I'll send it to what if as well. Okay. This is a good graph of it.
Okay.
Yep. Go ahead, Brian.
Long as we're paying under. Okay, so at 3 minus 1. So the long spread is 3 points. The short spread is 1 point. That means this thing has to trade for 2 below 17.
Right.
Okay.
So, yep.
And
I'll go back to the screen and illustrate it. Yep. So you got the 2118 is a 3-pointer. And you've got the 1718 that you're short is the 1-pointer. Right. So the most this thing can be at is $2. Right.
It has to trade for $2 is the way I'd say it.
Yes.
It has to trade at $2 below 17.
Yes. Okay. Let's go back and look at this again. So this might be easy to see. So you can see our 3-point call spread. That's one call spread. Pretend this. So just take one of these two and
put spreads.
Tie it to this. So that's your bear call put spread. Sorry. And then you got the extra one that you're short, and this one below. That's your bull put spread. Okay. So you're short the $1 and you're long the $3,
Mm-hmm.
right? You
Mm-hmm.
can make $2, but you are paying a debit of 178 for that in this example.
Mm-hmm.
So it's $2 less what you pay for it, 178, right?
Mm-hmm.
Comes out to be what? 22 cents. Okay. Now, that's if it goes all the way down here, right?
Mm-hmm.
So at this price, that's worth two, that's worth zero, but you paid 178, you make your 22 cents there. Safe?
And we're
Any
still
other
selling
com?
that at the money premium. But what's the maximum that it could be?
The maximum is you're going to make $2. I'm sorry, $3 on this.
Mm-hmm.
My bad. Okay, so you can make $3 on that spread. This one will go out worthless, so that's a zero. Less what you paid for it, back to our 178, right?
Mm-hmm.
Will be $1.22 for every, one lot spread you do.
Right.
Okay.
So if I did this trade, if I could get anywhere close to one, I'm going to get out. My goal is going to try to get to be 80 or 90 cents. I'm
Mhm.
paying $1.75, and that means that at expiration, the VIX has to go up higher than it's been for quite some time. It's got to land
Mhm.
somewhere above 21.
Yeah.
And I mean that you could get unlucky, and it happens the day before. So I usually would end up closing it out, but
Yeah.
it's an interesting trade. I mean,
Yeah.
the VIX isn't at an extreme, but
Right.
I was okay with this when we put it together, and I literally was looking for one.
Yeah, and if you look at the P&L graph at expiration, if you held, just close your eyes. Here's the max profits, which we just computed, 122. There's your max loss when you paid for this thing. Okay, that all makes sense. Tells you where you make these things. And, according to mathematics, is a 99.3%, 37% chance this finishes in the green. That's pretty nice, right? Versus your 0.63 chance that it doesn't. So this is a pretty nice looking trade on paper. Now look at I can flip 100 heads in a row if I get lucky. So anything can happen here, but statistically, that's probably a pretty decent trade. Safe?
And
It's
that's
not
the way I
safe.
like to
It's safe
trade.
to say it's pretty good trade.
Right. So I don't like to just buy, now I will say this though. Like, so going into October, and I did actually do this on Options Guide TV, and it did pay out, but it didn't pay out as well as it did last year because October we didn't get the normal volatility that we usually do. It's usually
Hmm.
one of the more volatile months. And last year we had literally October 1st vol spiked. I did a trade on like November, I don't know, 28th or 27th, and the vol spiked on October 1st. But bottom line is, if I'm buying call side, I like to leg into the spread. I don't like to, because the thing with the VIX is if the VIX goes to 70 and you got a spread on, you're kind of like, oh, that was fun, right? I mean, you got, so the short call is killing you and the long call is helping you. So I don't mind like putting, if I expect volatility, buying a long call and then maybe selling a call at a later date or just closing it out.
Hmm.
But if I'm doing that, I'm going to watch the VVIX. The VVIX is the VIX of the VIX, and it literally exists. It's a 30-day volatility index on the options that are based on the VIX index.
Hmm.
And usually, like right now, it's trading around 90. High would be in the 120, 130. Anywhere below 90 is fairly low. And sometimes I will just buy VIX calls in that
Hmm.
instance. But if we're doing put side, I very rarely do that. And this is the way I always lean on the put side. I want to sell as much premium as possible. Selling call spreads is tough. Let's look at selling a call spread. Let's look at the 21, just right there. Sell that 21
Okay.
and buy, gosh, that's only 75 cents even. Well, let's sell the 18. Let's sell the 18 and go 3 points wide.
You sell
You'd
the
be
18
buying the
down below
21. Yep, you're close.
and then buy the 21.
Yep. So that's
Okay.
a short call spread.
Yep.
And look at that, you're getting 53 cents and you're selling it at the money. Like it's tough because of what you talked about with the volatility skew.
Hmm.
So this is a very interesting trade. Like I want to be, I think the VIX will go below 18. We got the actual spot index at 16 and a half right now. But
Hmm.
man, you're getting 50 cents for selling an at the money, we're based off of the future, an at the money short call spread. And that's mainly because of the vol skew.
Hmm.
So I'd much rather do what I just proposed, Lex. You
Yep.
know, and I guess that's the moral to my story. This
yeah.
is, if you're
Mhm.
thinking about VIX and you're like, oh, this must be an awesome index to sell short call spreads in. Well, guess what? Market makers know that.
It's priced
Right?
accordingly, is what you're saying.
Right. It's priced accordingly because that risk is there. So you're trying to make 50 cents. You're selling something that's at the money. You
Hmm.
got 2.5 points worth of risk. I mean, it's tough. So
Yeah.
I'd rather do something where I got a little bit more upside than the downside, like on the
Yep.
open wing butterfly.
Okay. Fair enough. Fair enough. We'll hit the little risk graphy here. Yep. Not as good a predictor either. Look at that. 63.36. So,
And that
okay.
was trying to compare apples to apples, right? You're
Yep.
at 18. You want it to stay at 18 or go below.
Yeah.
Um, if it goes
Okay.
above 21, you lose. Yeah, that's about right. I guess that's
Yep.
about right.
All right. What else? You want to answer some questions? I see. I just
Sure.
looked at the time here. We're at the end here, so we probably have to do that.
And I cleaned them up. So Elliot asks and I thought he brought this up right at the beginning. Is the VIX a bias indicator? And I'll let Lex kind of cover that one.
Is it a buy? What does that mean? A bias? What do
Bias,
we?
like is by looking at the VIX, does it show bias in the market? Is it showing? Is there a way to look at the VIX to see which way the market is going? I guess is another way that I
Um,
would say it.
so here, I don't have the precise answer. Here's my general answer to that,
Mm,
is that the beauty of volatility, implied volatility in options, is that it is a future looking device. It is looking forward. That's what implied volatility represents. Okay. So Contango and how the skew curve looks in VIX can all tell you a story. That's what the community and the geniuses are predicting that the future holds, as opposed to realized, underlying realized, which is a backward looking mechanism. So I always like to look forward in these things. And I think, could VIX be a bias? I like to use SPX better, but that's just me because I understand. For some reason VIX is upside down to me, and SPX I can think in normal terms and I can see skew. And skew for me is more telling in an SPX product. So that's my answer.
and it's always everybody's looking for absolutes, and there's really when it comes to any of these indexes, there's really no absolutes. You know,
Yep.
like I'm going to chase the most at the money open interest, and I think the market's going to go there. You know, there's no absolute with that, but people have tried that, and
Yeah.
I get that question all the time, and I feel like that's in the same realm.
Yeah.
Right. So with Chris Green, and I'll try to answer this one
Okay.
because it applies to more than just VIX options. What's
Okay.
the best way to handle options when the VXX and other ETFs do reverse splits? Is it better to close or hold the position? And my answer, whenever a reverse split happens or a split and you get an odd strike on your
Hmm.
option contract, you close it because open interest is going to dry up and volume is going to dry up, and it makes it very hard to get in and out. So I would rather get out of those options at any point in time, or do the math and figure out is it going to land on that strike.
Hmm.
Now, my other answer to this is I don't like to trade the VXX because it does things like this, right? The VIX isn't going to split. But the VXX will, and they run into that situation all the time. And I don't feel like it really tracks vol. It does all right. I mean, if you're doing it on a daily basis, and even the ETFs will say that this isn't a long-term holding scenario. This is a day trading vehicle,
Yeah.
and that's the way I look at them. But if it's going through a reverse split and you're going to get a weird strike, the Chicago Board well, actually it's the OCC.com tells you how they're going to be adjusted. Then I don't want to be in it.
Right. Good point too. And the VXX that we used to be specialists in that, and
Oh,
it was
really?
I don't want to badmouth the product, but it's naturally built to go down typically
Right.
because it's rolling. It's selling out a lower price futures and it's buying a higher price one, so it's just a drag. On every roll, it's a reverse drag. So and that's why the reverse split is so much. It just keeps grinding lower, month in and month out on that contango looking graph, right?
Mm-hmm.
So it can be brutal. All right, what's next? Has
Okay, has
something
not
has
been
not been
lower
lower
than
than 14 for,
14.
I think he means the VIX has not been lower than 14 for
Yeah, I didn't get to those ones, so I'll just close those out. So those are just statements that it hasn't been lower, and that's true. I mean, like I said, even in the VIX, I like to keep the moving averages up. I like to look at I like to keep a 10-day, a 20-day, and even the 200-day. And just, to me, those are the means because the VIX is so volatile in the short term. I want to know what the long term would be, which is the 200-day moving average. And then also look at what's, the 10 and even the 50. I just like to look at the moving averages because, the market wants to come back to them or go up to them, right? Either come down or go up. And the market wants to trade there. That's where the market wants to be. Okay.
Yep. You want to tackle this one? I just read this too. So yeah, I think it makes sense to me, but okay.
Which one?
The long one from Anonymous. We do buy calls on the VIX when it drops. You see that one?
Yeah, I do.
When it drops below 12. Now it's around 15. 45 to 60 days out, 30 delta they buy.
Okay.
Close half at the first spike. Close half remaining if it pulls back. Wait on the last bit. Only 5% of portfolio used to hedge more leverage portion of portfolio. Saved me in Feb of 2018 on bull puts. So
wow, so that's a very astute anonymous attendee.
yes.
Yeah, but that goes well with what I was saying. If I'm buying calls on the VIX, it's tough because you pay so much vol premium, but then again, you're buying them on the VIX because you're expecting that black swan event.
Mm-hmm.
So I'd rather just buy them. I'd rather just buy them than spread them. And even if I'm going to do, I don't mind doing the call side open wing butterfly like we showed as in general trade if I just want to do that. But if I really think vol is going higher and I want it, like I said, October's coming around, I have a tendency to buy some calls before October. I'm always willing to make that bet. Mm-hmm. And use that October expiration or the next monthly November expiration. So anonymous attendees is kind of backing that up a little bit.
Yeah, good. This is an interesting question. The next one from Mr. Gonzalez. Does the VIX follow and react to technical analysis, chart and candlestick patterns like regular equities? I would say muted. I would say it's muted only because of what VIX represents, right?
Right. And so that's where the moving averages come in. I pay much more attention to the moving averages. It wants to revert to the mean. And you can look at the shorter term if you're trading a very short term. Like if I let's say I was going to trade a 10-day VIX option and the VIX was trading at 12, where is the 10-day moving average at? Like it wants to get there. So VIX was at 12, the moving average is at 15. I mean, that's a very simplistic version of it. But yeah, I would expect the VIX to want to get back to 15.
Yep. Fair enough. Okay. For that butterfly that you did, Brian, how long do you need to hold it to get to $1 to make $1? It's got 15 days to go.
Right. It holds its value a lot like the SPX options, but it is a $16 underlying where the SPX is a $6,800 index.
Right.
So one thing that's nice about the VIX is the fact that it is a lower value underlying. Time decay is going to hurt it quicker than it would on an SPX like 0 DTE trade. So how long would I have to hold? I'm going to say 5 days remaining.
Yeah, I think that's right. I was going to say this. I was going to say 3 to 5 is my guess.
Right. And 3 is a better is probably a for sure thing, and 5 is a medium thing. But realize the VVIX is going to have something to do with that. So the VVIX being at 90, and that could spike, and that can always spike at any point in time. Mm-hmm. But if you're saying if everything stays the same and we hold this 5 days remaining, I think we'd be close to $1.
Right. Do you trade calendar spreads to help fund the long side? Not sure that on that one.
No, I don't trade calendar spreads in the VIX period.
Yeah, it's a hard proposition.
And in the retail space, they won't let you.
Yeah. From Becky, this is going to be me. I'm all over this one.
Okay.
You have any idea of when small accounts under 25K, that means she's talking about pattern day trading, which is my torch will no longer have limits and not allowed to trade per day, the per day trader rules. Okay. So I don't have an exact time, but what I do know is that the commission they opened that up for comment, to which I wrote a letter. Quite frankly, it's under my real name, or my full name. If you want to read it, you can go find it under FINRA. And many people wrote. So they asked for open comment. I commented. I think it's the dumbest rule on the planet, first of all. It's just it's horrible for the smaller trader. It is not going away, but it's being reduced dramatically. What I have heard is it's probably going to go down to the $2,000 range with all kinds of caveats in there that will allow you to close things intraday without any bias relative to that $2,000 as well. So stay tuned for that. I would say my past experience with SEC FINRA has always been pretty slow to react. I think they finally understood this. We really hit them hard at some of the conventions we went to. I went to Washington D.C. recently, and that rule is already, water under the bridge by now. They already conceded on it and said you folks are right. It should be changed. So good news is it's changing. Slightly bad news is it's going to have a little bit of a limit, but there will be caveats in there that you can certainly work your way around that. So I think generally it's pretty good news. Any thoughts there, Brian, on that one? I mean, you're probably not as hardliner on it as I am. I mean, I wrote a letter on it for God's sake. You're on mute, by the way.
My son just ran up. So we're
Oh,
getting to the end here.
okay. We can do a couple more, then we can go. I know we're
Well,
best
I
on.
think we answered Sebastian already. The VXX is probably the most tradable, but we already kind of talked about that.
Okay. And
Okay.
that's Becky's follow-up on the IRA. Same thing there, Becky. No double top. Okay, that's just some comments. Okay, and that's it.
Yeah. I don't
All
think
right.
I've
So
ever answered every single question in
yeah, thank you. So folks, thanks for coming. I know we went over a little bit, but interesting topic. We have a poll for you if you want to stick around. And I always forget to do this stupid poll, and it's 6 questions. So have at it. It's just I think you can go through this, right? Do you have a Tradier brokerage account? I don't know how to, do they do this on, do you see it, Brian? I don't see it on
I do
mine.
see it.
I see it, but I don't know. Does it, I think you go through it yourselves. Oh, okay. You guys are doing it. You're smarter than I am. You're figuring this out. So if
Mhm.
you would please answer that, we're going to get the results. We're trying to make it better. So give us topics. Let us know things you want us to talk about. Let us know things you want us to talk about on our media channel, which is hub.tradier.com. I will put that in the chat. And don't forget to register and subscribe there because it's free. And Brian and I are hosts. We have different shows. I'm on Thursdays at 9 a.m. Central Time, Traders Workshop. Brian, when are you on?
I'm on Monday, Wednesday, and Friday at 11 a.m. Eastern Time.
Okay, and that's
And
live. Yep.
I want to throw out there that I'm answering Jim's question, and it
Okay.
should be in the Q&A box. Everybody should be able to see it, but it's an article that I wrote called Decoding the VIX in my X.com profile. So I'm going to send
Okay,
it.
good.
Everybody should be able to read it and maybe even click on it. Okay.
Awesome. I love it. Love it. Love it. Um,
And I
very
do like the UVXY that, and Jim highlights that it's a better option chain than the VVIX, than the
oh, good.
VXX.
Okay, I love it. So let me
So
let me let this poll go. There's still a few more coming in, and then I'll stop it there. But great show, Bry. What else? We're going to be doing these Ask Lex series once a month, typically, give or take the holidays, depending on how that all falls. But we will have different topics every month. Maybe some different guests, maybe some same guests. Maybe Brian will join me again if he still likes me. Um, and we'll do a lot of this. What other announcements? I said hub.trader.com. Make sure you sign up. All of this is going to be recorded and it'll be posted on Tradier Hub YouTube. The Hub page is being redone for 2026. You can still use the old one, but the new one is going to be really cool. I've done a whole educational series with CBOE, NASDAQ, and OIC that will be published on the Hub, and it'll be for your viewing pleasure and educational, we hope. What else? Trading contests coming up for big time money, upwards of 50 grand in prizes for the winner. So make sure you get to the Hub and start learning about that. We will be posting that sometime in the new year. That's going to be exciting. And last announcement, I'm a walking commercial. Sorry, two announcements. New show coming, the market wind down. It's going to be a little lifestyle with one of my co-hosts. We're both big into wine, so we're going to be talking about a little bit of lifestyle wrapped around a pill of finance. It's like giving a dog a pill and you wrap it in cheese. You wait to see it. It's going to be awesome. And that is sponsored by our friends at MyX, the exchange, who are really making movers and shakers. And really, the last announcement, next year's summit. We do these online, and we've done them since COVID. Next year's is going to be live. We are planning a live summit, probably somewhere in Florida. It is going to be spectacular. I think I'm going to convince Brian to come and present, and we're going to have a one heck of a good time, and it's going to be very educational. We're going to have some great people in the industry show up. Make sure that you can come for that. It's going to probably be in May, but you'll learn more, especially if you subscribe to the hub. Okay, that's it. Thanks everyone for coming. Appreciate it. That was awesome. You guys are all delightful and super great out there. I'm going to take this poll and we'll study it and hopefully improve. Brian, great to see you, buddy. And as always, happy trading. All right, Brian. See you later, bud.